I've read Winning the Loser's Game. He writes investment policy as well. He says the evidence on investment managers and their success with market timing is impressive and overwhelmingly negative. You will not find an academic that will tell you that you can beat the market. You'll not find an academic that will tell you that track record investing works. Everyone who's studied the market will tell you that it doesn't work. No one reads university journals. Everyone reads advertisements and prospectuses, right? The salespeople hand you advertisements and prospectuses. You see and hear all these, you see the whale coming out of the water and we all feel warm and fuzzy, right? But no one's reading the investment journal. No one can predict the market, and that's essentially how we're called to do investing. Myth 4, the cost of investing. The cost of investing are fees incurred by you, the investor, to buy, sell, own stocks, mutual funds. And everybody knows it costs money to invest, right? You have to pay something to be a participant. You can't invest for free. You recognize that. But the myth is what you don't see can't hurt you. And this is a bit of a difference between fees and commissions. And then we're talking about the commissions that you can see as well as the commissions that you can't. The costs of investing are a couple. We'll just go through the bid and the ask spread cost. And then there are wrap fees in mutual funds as well. I'm trying to move around enough. Can you guys see the screen for well enough? Okay, try to stay out of your way a little bit. The bid and the ask spread. This is in your book as well. I'd love for you to take down a couple of these notes if they're not there already. How many of you have purchased a stock by itself? Just gone in and bought a stock? Some of you have an E-Trade account or something like that. It's fun to do. You go in and you want to sell IBM today, and let's say it's $49.50. And you go online and you figure that's the price. So you're thinking about it and you think, I think I'm going to sell 100 shares of IBM. And then you read something or you're sitting and watch TV and one of these IBMer commercials comes in and you think, you know what, I really like IBM. That's a nice IBMer. I want to own an IBMer. So you say, you know what, I'm going to buy more of it. You go back and nothing really happened in the market. The prices haven't changed, but the buy price is higher than the sell price. The market maker gets the difference, and the market maker is the wirehouse like a TIAA-CREF or like a Fidelity or like a Pacific Life. They own the post that is directly behind the guy who's generally screaming into a microphone from below, and the bell goes off, and they've got little microphones here that they're speaking into and little computers that they're typing into, and the post is tall. It's got computers and TV screens all the way around the edge. They used to do it with tickets, but this is where the stocks are bought and sold. If I wanted to buy and sell stock between Mark Lafayette and I couldn't. I couldn't sell Mark stock directly. We have to go through a market maker. And this is good for all of us because we all know what the price of IBM is today, right? It's a part of our nation's best heritage, our property rights, and the fact that we know what prices are. The MLS does the same thing for us in real estate. And now we sell and buy homes sometimes outside the MLS, and that's okay. There's nothing wrong with that. But by and large, we like the MLS because it tells us what real estate is worth. Same thing with the stock market, and we're willing to pay a commission for that. But you would have to recognize if you can minimize your commissions, your buys and sells, that would be a pretty good thing, right? Because every time a stock is purchased and sold inside your portfolio, it costs you money. The market maker makes money. All right, if you look at large companies, at the top list, the price is relatively small. If you look at small companies, the price is relatively large for every buy or sell transaction. Charlie Ellis writes again, the key questions under the new rules of the game is this: how much better must an actively trading manager be than the market to overcome the costs that he or she incurs inside the fund? The average mutual fund owns 250 to 300 stocks. There are, on average, 275 or so trades made inside that mutual fund every year. Close to 100%, between 95 and 110% turnover inside the fund. Now, you're told to buy and hold, right? We're long-term investors. We want to own the market. See what the market's done? It's gone from here, and it's gone all the way up to here. Don't you want to participate in that? Yes, we do. Okay. Then why inside your mutual fund is the mutual fund manager buying and selling as if their life depended on it? They make money whether the market goes up and down so long as they're turning it over, right? They make money on the bid and the ask spread. And it's at least, if anything else, a conflict of interest. Because there is no evidence whatsoever in the world of investing that you can find that tells me that turnover, or an increased turnover, creates positive return for you. But there is evidence that they make money if they do it. Costs, what you can't see, can't hurt you. The bid and the ask spread doesn't show up anywhere. Now you can see your expense ratio. You can look into a mutual fund and say, hey, what's the expense ratio? This one's 1.25, this one's 1.75, I'll take the cheaper fund. And generally that's a good idea, because as expenses go down, generally efficiency goes up. That's proven. But the turnover rate is the more important number, and you can find that too. Okay? You need to know the turnover rate inside. Anything over 30% turnover is costing you money. And you don't see it, because it vanishes, right? They sell a stock and they buy another one, and it's gone in the price. It doesn't. They don't track it. We can only put an algorithm together to estimate that if someone has 100% turnover in a mutual fund, it's probably costing you about 2% per year. But a lot of it is very hard to track. All we know is that mutual funds don't beat the market by and large, or they don't repeat. We don't exactly know why, but we know that this is a contributor to it. So now that I've completely depressed you about everything you thought about investing, you want to use a track record, or you want to use a mutual fund manager who knows how to pick stocks, or you want to try to trust someone who's going to get you out of the market at the right time, these don't work. They're myths propagated by institutions that benefit for you to believe them. But we're going to talk about the truth as well. And to make sure that I don't give Liz a coronary, I'm going to keep track of my time so that we can make sure we're getting dinner going on time here. We'll get done in the next 20-25 minutes. So the story of investing is free market portfolio theory. Our funds are called the free market funds. You can Google those and read up anything you want to about them. What is free market portfolio theory? It's an investment approach firmly grounded in the academic research of the past 50 years. And it's a disciplined approach, disciplined on your part and on my part, to capture market returns while managing volatility. Most mutual fund managers are trying to beat the market. They can't do it. What you should do is you should try to capture most of the market and keep your expenses down so that you can enjoy most of the market's returns. The market has returned a tremendous amount of wealth. $10,000 over 20 years becomes $56,000. You don't need a better return than that. And in fact, you can't get it. You just need to determine how to capture it. So we need to get Wall Street out of our pocket in all of their activity. So we're going to go through this in components 1, 2, and 3. How do you do that? How do you get yourself to the place where mentally, emotionally, and practically in your portfolio, you're designed and built to get the market return? Because so few do. In fact, the average investor gets less than 4%. If you really wanted to be fastidious, you could read the books that these guys wrote. I can get these names to you. I'd be glad to do it. Just email me. I do get an email every time we do one of these that someone wants to see that, and I'm glad to share those. These are the people we read and that we follow. There's a great little blog that Eugene Fama and Ken French put out every week or so that I've signed up for. You can just Google Fama French and get their blog every week. It's just high-level investing stuff that gives you a sense for the fact that academics really, when they know what's happening behind the scenes, how do they invest their money? Component number 1 to doing this right is a philosophy, and it's understanding that free markets work. And recognize free markets aren't perfect. I know what's going on out there. Last night's speech and the previous debates that were going on, there's a big argument as to whether the markets are best at setting prices or whether government needs to come in and set the prices of money or interest rates and all of these things. I tend to believe that in general, it's best to let the market do its thing. We're not going to discuss that. But with respect to owning a stock share, okay, for lack of a better number, we are going to assume as investment advisors that the current price of a stock is a good indication of that company's value. Now, where you hear a different set of ideals on this is when you're coming home from work and you're reading the news, or when you're going into work and you're hearing the news on the radio, and they'll say Bank of America is a buy today, or Wells Fargo just was reduced to a sell, right, or a hold. What essentially they're saying by saying that is they believe that the price of the security is different than the company's value. If they think that Bank of America, for example, is a buy today, then they believe that it's underpriced. And what I'm saying is that that can't be known. It might be true, but it can't be known. And the best indication for investors is to use the price of a security for the value of any company at any point of time. Make sense? It's the best estimate we have. Because information is moving real time. It's moving very quickly. Everybody has all the information that everyone else has if they want it. And prices reflect the market very, very quickly, as we've seen in housing and as we've seen in many different cases. But let's think about this from the contrary for a minute. Let's say that free markets failed. The market failed to price goods and services appropriately. Let's just say that that was true by and large. Then it would be possible for some individuals to step in and identify in advance some of these mispricings, right? I mean, it'd be possible for smart people to find the inefficiencies and say, okay, this one's wrong. We can buy this one now because it's going here. Well, if that was true, if markets don't work, then that would be true. Underpriced or overvalued markets could be forecast or predicted by some. Those forecasts and predictions or mispricings could be taken advantage of then, and it would be possible to increase returns or assuage losses in your portfolio based on that information, right? People with this view would utilize the traditional investment myths if that's what they believed. Truly, what have you got other than that? You have track record investing by people who think they can beat the market. You've got market timing on your own to say get in and get out of the market at the right time because I think the market is mispriced. You've got those traditional investment myths. But if free markets work, then based on supply and demand, the free market is the best determinant of prices.